Have you ever bought something thinking it was really valuable and then bam, it's worth just tanks? Like maybe a collectible or some tech that gets outdated fast.
Oh, definitely. Businesses deal with that all the time with their big assets and how they actually record those drops in value. That can tell you a lot about their real financial situation.
Exactly. So today, we're pulling back the curtain on that. We're looking at how companies handle these value declines, specifically following the rules from IFRS, that's the International Financial Reporting Standards.
Right. And our deep dive today is really grounded in the actual IFRS accounting standards. They lay out how and when a company has to admit, basically, that an asset isn't worth what they thought it was.
Okay, so our mission then is to get a good handle on the nuts and bolts of asset impairment under IFRS. We'll also, touch briefly on the US GAAP, just for comparison.
Yeah, to give everyone a rounded view of what these write-downs mean for a company's financial health.
Perfect. So let's dive in. Where does this whole process even start? How does a company first figure out an asset might have lost value?
Well, it all kicks off when the asset first gets put on the books. Initially, it's recorded at what it cost to acquire. It's historical cost.
Simple enough.
But obviously, time moves on, and that asset's value doesn't just stay static. You've got wear and tear, maybe new technology makes it obsolete, market conditions change, lots of things. And all that can lead to the asset being worth less. Which brings us right to the main topic, impairment.
So impairment is basically when the value on the balance sheet, the carrying amount, is that the term?
That's the one, carrying amount.
Okay, when that carrying amount is higher than what the asset is, well, actually worth now, either in the market or like for the company's use.
You've got it. Specifically under IFRS, impairment happens when the asset's recoverable amount, and that's a key term we need to unpack, drops below its carrying amount.
Recoverable amount. Got it.
But yeah, the first thing is just noticing signs, indicators that suggest, hang on, this asset might not be worth what our books say anymore.
Okay, right. So companies own tons of assets. Buildings, machines, brands. How do they know when to actually test? Do they have to constantly check everything?
Oh, no, that would be, well, frankly, impossible and not very useful.
Yeah, sounds like a nightmare.
IFRS has guidelines. For most assets, you only need to test for impairment if there's an actual indicator that it might be impaired.
An indicator? Like what?
Think significant drops in the market value for that type of asset, or maybe physical damage. Or even if the company's own forecasts show the asset won't generate the cash flows they expected, clear signals.
Okay, so red flags, basically. That makes sense. But are there exceptions? Assets that need a checkup more regularly?
Yes, absolutely. There are two main ones. Goodwill.
Goodwill. From acquisitions.
Exactly. Goodwill, and also intangible assets that don't have a defined lifespan. They're called indefinite-lived intangibles. For those two categories, IFRS says you must test for impairment at least once a year.
Annually. Regardless of indicators.
Annually. Even if everything seems fine on the surface, it's because valuing those assets is inherently trickier, Their value isn't always obvious, and impairment could creep up.
Forces a regular reality check.
Precisely. Especially with Goodwill, that annual test forces companies to ask, are we still getting the benefits we paid that premium for in the acquisition? It's a really important check.
Okay. And for, say, a regular machine or building?
For those, if an indicator pops up, you test. But companies can still test any asset anytime during the year if they suspect a problem, even without a specific trigger from the list.
Gotcha. So indicators mostly, but annual checks for Goodwill and those indefinite intangibles. Now, what if you can't easily figure out the value of just one asset because it works as part of a bigger group, like a production line?
Ah, yes. That leads us to the concept of a cash-generating unit, a CGU.
CGU.
A CGU is basically the smallest group of assets you can identify that generates cash inflows mostly independently from other assets or groups.
So like a specific store in a retail chain, or maybe one product line.
Exactly like that. Or think of a specific factory, maybe. It's machines, the building, they all work together to produce goods and generate cash. You often can't isolate the cash flow of just one machine in that factory.
Right. The whole unit makes the money.
Correct. So in many cases, it makes more sense to test for impairment at the CGU level. It's often just not practical or even possible to determine the recoverable amount for a single asset within that integrated operation.
Makes sense.
Though it's worth saying, for maybe smaller companies or very unique assets, sometimes a single asset can be its own CGU.
Okay, so we know when to test indicators or annually for some things.
Right.
And we might test a single asset or a whole CGU. Now let's get back to that key term, the recoverable amount. How do they actually figure that number out?
Right, the recoverable amount. This is crucial. It's defined as the higher of two different values.
Okay, what are the two?
The first is the assets, or CGUs, fair value less costs of disposal. The second is its value in use.
Fair value less cost of disposal, sounds like. What you could sell it for, minus selling costs.
Exactly. It's the price you'd get in a normal, orderly sale between willing, knowledgeable parties, minus any direct costs of making that sale happen, like broker fees, removal costs, that sort of thing.
Okay, the net selling price, basically.
Mm-hmm.
And the second one, value in use.
Value in use looks at it differently. It's about the value the company expects to get from continuing to use the asset, not selling it.
How do they calculate that?
It's the present value of all the future cash flows the company expects to generate from that asset, or CGU, over its remaining useful life. So they have to forecast future cash inflows, outflows, and then discount those future amounts back to today's value.
Using a discount rate that reflects risk and the time value of money.
Precisely. It's a projection of its earning potential in current terms.
Okay, so they calculate both the net selling price and the present value of future earnings potential. And the recoverable amount is whichever of those two numbers is higher.
That's it, the higher of the two.
Right. So
Yeah.
what happens if that number, the recoverable amount, turns out to be less than the carrying amount on the balance sheet?
Well, that's the trigger. If the recoverable amount is less than the carrying amount, then the asset is impaired, and the company has to recognize an impairment loss.
And the loss is just the difference between the two. Carrying amount minus recoverable amount.
Simple as that. That difference is the impairment loss?
Where does that loss actually get reported? Because, I mean, a big impairment loss hits the bottom line, doesn't it? That feels like really critical info for anyone reading the financials.
Oh, absolutely. Generally, that impairment loss is recognized immediately in profit or loss, straight to the income statement, reducing the company's net income for that period.
Ouch.
Yeah. There is one exception, though. If the asset being impaired had previously been revalued upwards, and that revaluation created a surplus in equity, like a revaluation reserve, then the impairment loss is first used to reduce that revaluation surplus.
So it reverses the previous gain first.
Exactly, up to the amount of that surplus. If the impairment loss is bigger than the surplus, then the excess loss still goes to profit or loss. But you sort of unwind the previous gain before hitting the income statement directly.
Got it. That makes sense. Now, thinking about CGUs, again, those groups of assets, if the entire CGU is impaired, how does that loss get spread across the individual assets inside it?
Good question. There's a specific allocation order required by IFRS. You don't just spread it evenly right away.
Okay, what's the pecking order?
First, you allocate the impairment loss to reduce the carrying amount of any goodwill that's been allocated to that specific CGU.
So goodwill takes a first hit. Makes sense. It's kind of the most intangible part.
Right. Goodwill often represents the premium paid for expected synergies and things in an acquisition. So if the unit isn't performing, that's often the first value to be questioned. You reduce goodwill first, potentially right down to zero.
Okay. What if the impairment loss is bigger than the goodwill allocated to the CGU? Or if there wasn't any goodwill?
If there's still impairment loss left over after wiping out the goodwill, then you allocate the remaining loss to the other assets within the CGU.
Wow.
You do it pro rata, so proportionally, based on the carrying amount of each of the other assets in the unit.
Okay, spread it across the remaining assets based on their value.
Yes, but with a really important limitation.
There's always a catch.
Well, a safeguard, really. When you allocate that loss to an individual asset, you cannot reduce its carrying amount below the highest of three things. Its fair value, less cost of disposal, if you can measure it, its value in use, if you can determine it, and zero.
Okay, wait, so even if the whole CGU is impaired, you can't write down, say, a specific machine within it to less than what you could sell it for or what it's worth in use, or obviously below zero.
Exactly. It prevents companies from just dumping the entire CGU loss onto one or two assets arbitrarily, making them look worthless when they might still have some individual value. There's a floor for each asset.
Right, a floor. That seems fair. Okay, so we've impaired the asset, recognized the loss. Can things ever go the other way? Can a company reverse an impairment loss if the asset's value bounces back later?
Yes, they can, under IFRS, for most assets. An impairment loss can be reversed if the situation changes.
Like how?
If there's been a clear change in the estimates used to determine the recoverable amount since the last impairment, maybe market conditions drastically improve, or new forecasts show the asset will generate way more cash than previously thought.
So if the reason for the impairment disappears or reverses.
Essentially, yes. If the recoverable amount increases again.
And how does that reversal get recorded? Does it just undo the loss?
Kind of.
Yeah.
The reversal increases the carrying amount of the asset back up to its new, higher recoverable amount. But another limitation.
Okay, what's this one?
The increased carrying amount after the reversal cannot exceed what the carrying amount would have been if no impairment loss had ever been recognized in the first place.
Ah. So you can't reverse it to a value higher than its original depreciated cost path, as if the impairment never happened.
Precisely. You bring it back up, but only to where it would have been, considering normal depreciation. You're not creating extra value out of thin air.
Got it. And where does the reversal show up? Back in profit or loss?
Generally, yes. The reversal of an impairment loss is usually recognized in profit or loss, boosting the net income for that period.
Nice for the company when that happens. Now, you mentioned Goodwill has special rules for testing. Does it also have special rules for reversals? Can you reverse a Goodwill impairment?
That is a critical difference. Under IFRS, the answer is absolutely not. An impairment loss recognized for Goodwill can never be reversed in a later period.
Never. Why not?
The thinking is that any subsequent increase in recoverable amount related to Goodwill is likely due to new internally generated Goodwill, perhaps from later investments or improved performance, not a recovery of the specific Goodwill that was previously judged to be impaired and written off.
So once Goodwill is written down, it stays down. It's a permanent reduction.
Permanent. It's a one-way street for Goodwill impairment under IFRS.
That's a really key takeaway.
Yeah.
Goodwill impairment is forever. Okay, now, you mentioned we briefly touch on US GAAP. How does it differ? Just the highlights.
Sure. Well, the basic goal is similar. Don't overstate assets, but the mechanics can vary. For Goodwill, US GAAP often uses what's called a reporting unit for testing, which might not be the same as an IFRS CGU.
Different grouping.
Potentially, yes. And US GAAP traditionally use a two-step test for Goodwill impairment. Step 1 was a screening test comparing the reporting unit's fair value to its carrying amount. Only if it failed did you move to Step 2 to actually measure the loss. IFRS uses a one-step approach comparing recoverable amount to carrying amount directly for the CGU.
Okay, so a different process there. Anything else?
The specific indicators that trigger impairment testing for other assets might differ slightly, and the detailed calculations for value and use or fair value might have nuances too. But, as you said, the overall objective aligns. We're focused on IFRS today, so that's just a quick flavor of the differences.
Understood. Different rule books, similar aims. So let's bring this all back home for the listener. Why should someone trying to understand a business really care about these impairment rules? What's the big picture value here?
It's absolutely fundamental if you want a realistic view of a company's financial strength. Recognizing impairment losses means the balance sheet isn't inflated with assets valued higher than they're actually worth. It gives you a truer picture.
More honest numbers.
Exactly. And because the loss usually hits the income statement, it reflects the real economic cost of that value decline in the company's performance for the period. Understanding this helps you judge if reported earnings are sustainable. Well, think about it. Large or frequent impairment losses can be serious red flags, right? They might signal that past investments aren't paying off, or maybe the company's tech is becoming obsolete, or the market it operates in is facing major headwinds.
So it helps you look deeper than just the headline profit number.
Precisely. It gives you insight into the quality of the company's assets and its ability to generate value from them in the future. It's about assessing the real economic health, not just the accounting figures on the surface.
That's a great way to put it. It's like a reality check embedded in the financial statements. Okay, let's quickly summarize the key points from our chat.
Sounds good.
All right, so under IFRS, impairment testing for most assets is triggered by specific indicators. But for Goodwill and indefinite-lived intangibles, it's an annual must-do.
Right.
The test itself compares the asset's carrying amount on the books to its recoverable amount. And that recoverable amount is the higher of fair value less selling costs.
And its value and use.
Right. If the carrying amount is higher, boom, impairment loss. Usually hits profit or loss.
And these losses can sometimes be reversed later if things improve?
Except for Goodwill.
Yeah.
Goodwill impairment is final,
Never reversed. And testing is often done at the CGU level for groups of assets.
with that specific allocation order for losses within the CGU, starting with goodwill first.
You've got it.
Okay, so here's a final thought for everyone listening. When you see a company announce a big asset write-down, a significant impairment loss, pause and think.
Mm.
What could that be signaling beyond just the accounting entry?
Yeah.
Could it point to deeper problems in the company's strategy or maybe wider issues across its whole industry? If you see a large impairment charge, what else would you want to find out to really grasp the full story and what it means for the company's future?
That's a great question to ponder. It's often a number that tells a much bigger story.